Good afternoon, Mr. Cole Smead. Thank you very much for doing this. Again, I appreciate your time.
Yeah, good to see you again.
As a reminder to the listener, you are the CEO of Smead Capital, but what is Smead Capital?
Yeah, so we run about $6 billion as a firm. We are value buyers. We run concentrated portfolios, mostly through mutual funds, in the U.S. and also in Europe today. And we run both U.S. equities as well as international. And so we own a lot of Canadian issuers north of the border as well.
Big skier, too. Do you have your next trip to Banff planned this winter?
I don't. This is a few years back, but I used to start the season the first weekend in November when they would open Sunshine. I
Mhm.
did that a couple years in a row. Definitely took my daughters to cows there in downtown Banff, and like a good Canadian tourist, went to Earl's there in town for
Mhm.
dinner one of the nights. But I haven't been to Whistler for a while. I used to go to Whistler a lot when I lived in Seattle, and so I miss, as Mir once said, the mountains are calling, and they always are.
Well, you'll have to get back to Canada to get some fresh powder skiing in, hopefully this winter.
Yep.
For those aren't familiar with Smead Capital, maybe as a refresher, how would you describe the approach you guys take to investing? I think you were big fans of Ben Graham and Charlie Munger, and how does that philosophy guide your investing in energy today?
Yeah, it's a great question. What we tell people is we advise investors who play the long game through a low turnover, differentiated. I mentioned the concentration, value discipline, seeking wonderful companies to build wealth. So as you and I both probably could say, not a lot of people look around the world and say, "Gosh, a wonderful company is a great long life Canadian oil and gas asset." We do. So it's really how we define that. And I say that because what you'll often see in who we are is we'll think about things like supply. We think that supply of oil and gas is tighter than most people think. There's other businesses like that I can make the case on, but again, we like tight supply because it means you can't predict the future demand, but supply is a better thing to predict over time.
Would you consider yourself a generalist investor?
Yeah, I will generally go wherever I can to make money. That's what I consider a good generalist. And so, and if someone says like, your style, like, I'm a human. I have certain things that I'm going to want to do or have proclivities to do or experiences I've had. I call that the cumulative advantage you gain as an investor. That being said, the main style you want to have down is you build wealth over time and you do well for investors. And so, do you get good outcomes? I think most people tend to be really interested in the path that you're on, and I don't care about the path. I care about, did I, as an investor, or my investors alongside of me, get to the right outcome? And that's where people tend to fall short, is the outcomes.
One of the main approaches of Ben Graham and Charlie Munger would be to find undervalued companies, and that I think is what attracted you to the energy industry. When did you first notice that energy was undervalued?
Well, the only way to know what's real is you got to know what's counterfeit, right? Munger always says invert, always invert, right? So let's go back to what you knew was counterfeit in the energy business. It was called the 2010s. It was counterfeit. It was counterfeit because, Bay Street and Wall Street could sell it. It was counterfeit because the idea was you could waste a lot of money on CapEx, and that was going to work out all fine in the end because there was this great bull market and there was these emerging middle class citizens, and commodities are just going to boom, and you just got to hodl on that for a while. And it's going to work out all well in the end. Now, that's counterfeit. And I say that because out of counterfeit situations like that is where you find great investment opportunities. It's when those euphorias and manias end that you can then go in as the security analyst to say, hey, you know what? This is what was believed that didn't end up being true. Because I always tell people, we as humans and us corporately as humans, we never change overnight. We can only change over time. Okay. And so I think of like how I've matured as a person over time. You can't do that overnight. And businesses and industries do the same thing. So, for example, to take you back to then, CapEx, nobody cared about back then, right? Free cash flow, like, hey, here's my net income accounting profits. But if you looked at the economic profits of the business, they
Mhm.
were negative in many cases back then. And so that was a counterfeit view of a good time in the business. And what we end up learning is that couldn't sustain because cash is real. And ultimately, the businesses were showing no cash profits. Fast forward to today. Now, what do you see? It's not counterfeit, it's real, right? They're producing mass amounts of cash flows. We look at this through the lens of returns on invested capital, right? What is the total invested capital? Quick thing if you're an aspiring CFA junkie out there, take the book value, you add back the long-term debt, unless it's a line of credit, you might add that back, and then you subtract out the cash. Because that gets you to what the net capital is to run the business. And then from our chair, we look and say, what's the free cash flow minus the stock-based compensation that I get based on that net capital? And that's how we look at returns on invested capital. That's how you look at return streams in our chair. Now, to your point, as a value buyer, you want to think about, okay, if they're running these returns on invested capital, how would that compound over time? And therefore, what multiple would I want to pay on that on, say, things like free cash flow or right price to invested capital? That's what we think about a lot as investors. And I think free cash is super important, but I think people often get lost in the metric of price to free cash. When is price to free cash really beneficial? Well, in a company buying back stock, it tells you what percentage of the market cap they could buy back. And
Mhm.
so if you're getting a good return stream and it's sitting at low book multiples and you happen to be able to get a lot of the stock back, in free cash by buying back at the moment, that kind of captures like the crystallization of value, if you will, to the shareholder. And I think what we see going on across the industry, and if you want to talk any names, would love to, but we can see that going on where the industry is waking up to this. I mean, all the way out to, I'll use a couple names we don't own. Like Tourmaline's got an NCIB out there. Like Tourmaline doesn't buy back stock. They hand out dividends like candy.
Mhm.
Whitecap, we don't own them. But again, that's a dividend play most often for people. They have buybacks out in the market. And it shows you how the industry has moved from the idea of like drilling and capex and giving you dividends out to, hey, let's return capital. And by the way, killing shares off at good prices is a value realization strategy that wasn't present many years ago.
So, as a generalist investor coming up from the States with options, when did you start to become interested in this? Was it post-pandemic? Did something caught your eye?
Yeah, quick adage. This is like not what a wise man once said, but it's just something I've seen personally. If you haven't lost a little money in the energy business, you can never make a lot of money in the energy business. Okay. And I say that because we started getting interested in late 2019 in the energy business at large. We never got involved really in Canada until 2020. And I say that because we had to lose some money at the beginning. It's just the nature of the beast. And by the way, your great investment opportunities, you're always going to be early. You got to lose some money on the way. And that's not unique to the energy business. But I pointed out because what I've seen and what I've experienced in the space, whether you're talking US or the Canadian energy space, is again, if someone asked me like 2018, Cole, what did you know about the energy business? Or what did you know about Permian fracking or SEG D in the tar sands? The answer was zero. I knew nothing. Now, why? Because as a generalist, I didn't have a profitable reason to learn.
Mhm.
But today, I have a profitable reason to learn a lot. And so I say that because as you think about the interaction of how you invest and how you learn, you want to do your learning in places that can make you a lot of money. And therefore, you tend to gravitate your work as an investor around to things that are not like, oh, I want to learn to learn. No, I want to learn because there could be a big investment opportunity. And that's what we did in the space. So to take you back, our first investment in the space was buying Husky on the Synovus merger.
Mhm.
Okay, which happened in late 20. I'll never forget. People say like there's not bizarre things that happen in security markets. There are. If you go back and look at the day the merger was announced, if you could get enough shares to ARB, you could have bought warrants in Synovus at negative prices.
Mhm.
Let me repeat that. You could buy securities at negative prices. Okay,
Mhm.
now I say that because there are anomalies that happen in the stock market from time to time. They don't happen every day, but it just goes to show you that these are not perfect markets. There's humans that underlie these, and they can often be very wrong. Okay, and so that was like our gateway drug was getting involved with Husky to get into Synovus. And then from there, you begin learning. And so you learn about this asset called Christina Lake. Well, isn't it interesting? There's another asset next door to Christina Lake that everyone seems to have suddenly figured out that goes well with other businesses called Meg. And
Mhm.
so you do a bunch of learning on Christina Lake and then you get involved in Meg as an investor. And you just continue to grow in your learning of what they're doing. And I say that because that's a pretty typical process, right? You learn something about one thing, you look and say, oh, but if it applies to this, I can use the same lens of looking at another investment security in the space. And it's just kind of grown over time. I would say my bias to the industry is that there's a lot of professional management teams in the industry. Okay. And when I say professional management teams, what you should read in is between the lines, it says, AKA not owner operators, right? Not the kind of people that are sitting down and saying, I'm going to have my entire net worth wrapped up in this. I'm going to stake a lot of my future fortunes on the success of this business. They are collecting economic rent. They might be doing a good or bad job of that, but ultimately they're not an owner operator. They're not, really throwing their capital allocation around in a way that gets the shareholders the wealthiest. They're doing it in a way that might not lose. And that's very different than playing to win. And as investors, we want to play to win. That's the goal in this thing.
Speaking of undervalued energy names, you have a few in Canada that we'll get to, but before that, you also have options in the States to invest in it, US energy. Does many options stand out to you in the States right now versus Canada? How do you think about comparing the two markets?
Yeah, when you look at returns on invested capital and price to invested capital multiples, they look like very similar in a lot of cases. For example, can I go out into Canada and buy businesses that are trading for less than their invested capital? The answer is yes. The
Mhm.
question I would ask is like, what's the returns on those? And you can find similarities. So I'll give you an example in the States, and I think this fits. There's a lot of things like this in Canada too. So I'm not saying it's unique to just the States, but we own APA. Okay, APA is primarily a Permian producer. They also produce in Egypt, but they have what I'll call three long-tailed, long-term assets in Suriname, also Uruguay and Alaska. Okay, so why do I like the business? Well, it produces about say 11 to 12% returns on invested capital. And if you said, "Well, Cole, that's not super high," I'd say, "Yeah, it's not terribly high." But here's the catch: I can buy it at roughly 60 cents on invested capital. So, why do I like using invested capital? Because it means that as a business matures and debts come due, they're going to naturally pay off those debts, which means in the long run, the metric you're using is it's going to trade at book. Why am I using book? Well, they're capital intensive businesses, they're cyclical. That tends to be the kind of assets that don't trade at big book multiples over time. But the question for me is, do I like the return stream to get to book and just meeting the maturities of the business as they come? In APA's case, I think what's really interesting is they're a good poster child of the consolidation, not dissimilar to what we're seeing kind of go on in Canada, which is that we've now had the Hess situation pass us with Chevron and Exxon Mobil.
Mhm.
So someone goes out and says, okay, what if you want to get a lot of Permian assets like Hess and also get offshore assets that would match what the majors want in long life assets that they can kind of go call on and put capital into? Well, congratulations. I just explained APA. So someone could come in, like we're seeing in Canada, and do an all stock deal to acquire APA, I don't know, 30% premium over the current price of the business. And what you're getting is you're getting accretion from the buyer into the new parent company. And the flip side is the existing investors aren't getting stopped out on a cash basis. They would be waking up to own a business that ultimately is going to generate, attractive returns on invested capital going forward. They're just getting a nice markup in what they're going to. And secondly, liquidity. And these are all common themes that, again, if you look at the transactions going on in Canada, they're all common themes. Accretion, the current owner is getting a step up in value on an all stock deal, and ultimately liquidity is being added to the pie. I mean, that fits the template that we're seeing in Canada, and I see that a lot. Now, here's another thing from a arc of history thing, and you probably heard me say this. I think we talked about it when we were visiting in Calgary during the Stampede. But the arc of history is there's two railways in Canada: Canadian National Railways and Canadian Pacific. Okay,
Mhm.
that's where we're going in the oil and gas business in Canada. That's where we're going in the oil and gas business in US. So you look at there's a transaction going on right now where Union Pacific's trying to buy out one of the other railroads in America. Congratulations. The arc of history is going there in that business just like it is in the oil and gas business. So again, my theory, our theory here at Smead Capital Management, three Canadian oil and gas businesses in 20 years, 15 years, something like that. We know that CNQ is going to be there. We know that ultimately Suncor is going to be there. I say that because the same thing will hold true in the United States. We know that Chevron's going to be there. We know that ExxonMobil is going to be there. Someone said, Cole, there's going to be three or four because maybe there's one more in America. Sure, it might be EOG, it might be Diamondback, it might be Oxy, but that's kind of the three that would be left to take up over the mantle. So if this is an eat or be eaten world, go focus on SG&A or G&A as a percentage of your revenues. That's the metric we're really going to get down to because every time you can bring that cost down, you're just adding incremental return on capital back to the business. It's to scale business, go look at banks or any place else in Canada where scale is a big deal because it's capital intensive. Same thing's true in America. Your cost to run your business just get a lot more scalable in these type of industries. And so this is just not this is Harvard Business School case study type of stuff. I'm not, this is not some novel concept, and I'm not doing anything other than what you've seen in other business models where there's been a roll up and scale showed up over time.
And my argument would be you could throw Tourmaline in there, maybe CNQ as well for Canada.
Well, but again, now to your point, I think the world of Mike Rose, I always say very, great things about Mike because he's done a wonderful job. They are the most successful pure nat gas player in North America, in my opinion.
Yeah. Shout out to Tourmaline. But
Yep.
you've also got options in the States, like you've mentioned. So do you see as many undervalued names in America, or how are you weighting your portfolio, Canada versus the US?
Yeah, so in our U.S. portfolio, the only Canadian name we own is Cenovus, and if we want to go into this, we think Cenovus is dirt cheap. We think their stock's too cheap right now. Okay, not because of all their downstream woes, but because of all their upstream assets. So that's the only non-U.S. issuer to a certain extent. It's obviously traded in New York as well, but from a pure non-U.S. issuer perspective, it's the only one we don't. Now, why? Because ultimately we got the liquidity and the kind of assets that we wanted in their case. In our international, what we call our ex-US portfolio, we own Imperial that we bought last summer about a year ago. Imperial was cheap back then. The returns on invested capital were attractive, and we just didn't think people were paying the right multiple for the business. You wake up 1 year later, and Imperial kind of looks expensive at this point. It's kind of outpunched everything that people have thought. CNQ went from being a lot more attractive to a lot of the quote unquote generalists or people that just dabbled in the highly liquid ones. And Imperial's kind of being put up on a pedestal. We also own Cenovus in our ex-US portfolio. That's, like I mentioned, that's been around ever since Husky. We like playing the long game and owning for a long time. So once we get involved in a business, we tend to stay around for a very long time. We own Meg up there. So I look at like at this. I think in our U.S. portfolio, because it's most of our assets, there is a liquidity issue we have to deal with, which is that we need a big liquid issuer. The major Canadian businesses like a Suncor, like an Imperial, like a CNQ, they would fit into that liquidity profile. I would say, generally speaking, 10 billion and up in Canada, US dollars from a market cap perspective, fits what we're generally looking for. But that number, that filters out a lot of names in the Canadian space versus our ex-US portfolio. We don't have that same liquidity constraint. We tend to be $1 billion US market cap or greater is where we tend to fish in that pond. Even out to to throw out a name that's totally outside the Canadian oil and gas space, we were looking at Spin Master, which is a business I've looked at over the years, and is a Canadian business that produces like Paw Patrol, but they have some really good assets, and so we can be a little more opportunistic on market cap ex US. But do I think it's demonstrably cheap? Yes. Generally speaking, I tell people the Canadian oil and gas business, just like a lot of the US oil and gas business, it's all a buy. In my mind, if you went out and said, I'm not going to own the S&P 500, I'm just going to buy some ETF representative of the basket, you're probably going to beat the S&P. You're probably going to beat the TSX. Okay. That's not the question as an investor. The question is, if you're right, how do you make the most money?
Mhm.
Okay. You want to make odds, as they say in gambling. And so that's what we think a lot about is how do we make the best money for the risks that we're taking in these places. And most of that, I would argue, in a lot of these businesses, either the price and the return stream, but thirdly, the capital allocation of the executives at these businesses is going to be a fundamental difference of the business, which is why some of the M&A and the capital allocation going on right now we think is so meaningful.
You also have a fund that you're launching in Canada. You are going to launch that, I think, within the next year or so, if I'm correct. But maybe for the listener, what is that and how does it relate to investors?
Yeah, it's a great question. We've had a lot of Canadian investors over the years who've just read our writing, followed us, things of that nature. And I mean, I've spent a lot of time in my life vacationing in Canada and just doing stuff. I enjoy doing business in Canada. I'm super biased. It's kind of a little bit of a pet project of mine. But I say that because we're in the process of, we're about to register with the Ontario Securities Commission in Toronto to go out and be what they call an IFM or investment fund manager and advisor. And that will beget us launching a prospectus, what's referred to in the regulatory bodies as a traditional Canadian retail mutual fund. If you're looking for the regs, it's 81102. We have good lawyers, just so you know. But I say that because we want to go out and serve Canadian investors, and the portfolio we'd like to go out and provide initially would be our ex-US portfolio. Why? Because we own a lot of Canadian issuers that they would be able to understand and understand how we go out and manage money. That would be ex-US, so we can own anything outside the United States. It would be really a mimic of what we're already doing for our US investors in that same portfolio. But again, what I've noticed in Canada, there's a lot of bank product, and bank product is good if you're a bank, and it's not so good if you're an investor. And so it tends to be very benchmark hugging. It tends to not charge cheap enough fees for benchmark hugging. And so we're going to come out and say, hey, we're Smead investors and we serve people over time and we like good outcomes. And we have our own capital trapped up in this because we're skin in the game, folks. And if that's the kind of thing someone's looking for, that might be the kind of investor that would want to have a dialogue with us. And so that we're really excited for that process. As I mentioned, I like coming to Canada. So anytime I can be there to do business and like you said earlier, maybe ski on the weekend, it's a win-win.
And some of the names that may or may not be in the fund that you have positions in or have had positions in include Synovus, Strathcona, Mag, and I think you mentioned Tamarack earlier. So
Yeah,
what attracted you to these businesses and why'd you get involved? You've kind of covered what you look for earlier,
yeah.
but how come?
Yeah. So and I'll use the Synovus originally. One of the first things we're always looking for, and we have 8 criteria for picking stocks. If you want to go on our website, you'll see our 8 criteria there. But we like strong insider ownership. It's something we always look for. So it's something you'll tend to see. We don't always get it, but it's something we prefer, all things equal. So I'll use Synovus. When Husky Mag was put together, Lee Cushing's entities were the large insider. Okay. Why do I like large insiders? Well, two things. Historically speaking, founding families, founders, things of that nature, they tend to exhibit two things. They tend to exhibit one, they run higher returns on assets, all things equal, right? So if you just have that present in the aggregate data across security analysis, you find higher returns on assets. That's one. Two, in times of crisis, they tend to they're more agile with their capital structure. So, for example, let's say we're the board of, I don't know, Banff and Company, and we run a ski lift in Banff, and we're like, uh-oh, a pandemic's ensuing. We need to like get this done right away. But you and we own the whole business together. So I call you up and say, hey, Trevor, board meeting's going on right now. I'm calling RBC tomorrow, and we're drawing our lines of credit because we got to make it through this. Okay.
Yep.
And so that's what we would do in a family-led business. Okay. Now, if we're a professional management team, like you and I might have that conversation. Like you're the CEO, I'm the CFO. I'm like, dude, you're right. Let's go do this. We got to draw our lines of credit. But then we got to go to the board and we got to be like, hey guys, we need a board meeting together, and when are we going to schedule this, and so on and so forth. And by the time we finally draw the line of credit, whether we get that decision done or not, the crisis is already over.
Mhm.
And we might already be in such a pinch that we're too late. Okay. And so I say that because they tend to be more agile in times of crisis like that. So I think a lot about those things. Now, if I'm giving you the postmortem, like we did like Lee Cushing's entities being involved, because at that time in late 20, it's not like the business of oil and gas was in some great mood and position. And to call a spade, it's not like Husky had done well. Okay. So I say that because, obviously Lee Cushing's entities don't want the value of their business to go to zero. And so that's another binding force. They have an interest in their own in what they're doing. So when that deal was announced, I mentioned earlier that there were warrants kicked off on that. And so in our view as investors at our firm, we looked and said the only reason those warrants were present in that deal is because Lee Cushing's entities bargained for that. Now, here's the great part to being a minority. When you have people that are acting on your behalf like them, you get it gratis, right? Every shareholder got those warrants, and you got a cheap call option on the future of the business. If you go back and look at what those were priced at, they were priced at nothing relative to what they've been worth, for more of the time. So we always like those situations where you have other people doing work on your behalf. And I think by explaining that, it can really help, your listeners understand, like say Strathcona. Why are we so interested in Strathcona? Well, we have these folks called the Waterous family, and you have the people that are working at the business, and they have certain incentives that are aligned with us. So therefore, they're doing things that are in our interest. Those are commonalities that we love to deal in. And anytime we can find great capital allocators, which I think we have found in that case, we love to. Now, if I was going to give my postmortem of Synovus, do I think Lee Cushing's entities are great energy investors? No, I don't. That's what I've learned as an investor. Now, do I really like the asset we own? Yes, we really like those assets. So we ended up learning that, hey, it wasn't really about them as an owner, as being some incredible capital getter. I mean, they're selling Synovus right now. That makes no sense in my mind. This is one of the weaker prices on Synovus. We think they're too cheap. It's also why, spoiler alert, I don't think they're going to offer on Meg because their stock is too cheap and you want to do all stock deals right now. And so watching them sell out of Synovus is, did they get a better price than they would have if they'd sold out at the low? They did get a better price, but go follow their purchase of Husky to today and what they're getting out of Synovus. They lost money. They're not the right investors to follow. But again, when you're in a time of crisis from a capital structure perspective, they weren't going to allow their business to go BK either. And so I think it teaches you a lot about risk reward relationships with having people like that involved. In the case of Meg, we don't have a large insider like that. I think there's only one director that owns anything of note. When I say of note, in other words, like has purchased in the open market over time. You mentioned Tamarack Valley. There is not a big, large insider like that. So we'd prefer it all things equal, but we don't have to have that to be an investor. But again, if you're going to dip your toe into an industry that you've never touched before, that's a great place to start. And if you look at on the US side, one of the businesses we were most aggressive on early on in 2020 was Continental Resources. What did they have? They had this guy named Harold Ham. And I'll throw this out, the best capital allocator I've ever seen in North America. But he was an 82% owner of that company. And so again, I saw a great capital allocator. We got to get involved with one. He ended up buying us out. He kind of chastised us in his book. But he's a great guy. And from the perspective of, he's done really well by shareholders and he treated them like you want to be treated as a shareholder side by side with him.
Speaking of the US, shale production,
Yeah.
$60 oil or in that range has made it difficult for the various shale companies to make money at. But on the other hand, free markets still exist. There have been
Yep.
calls to cut production to try to get the price up and various strategies in that end. What do you think is the best strategy forward in that scenario?
Yeah. It is shut in, baby, shut in. I mean, that's the strategy. Look at rig counts and frac crews. They're going off a cliff. Okay. So I know that I'm going to get a little philosophical for 2 seconds. Okay. So, really quickly, everybody, I'm going to give a quick economics lesson. If you want to produce more in a market, you always want higher prices. If you want to produce less in a market, you always want lower prices. Okay, that is economics 101, just so we're on the same page. So when you hear politicians come out and say, we're going to produce a lot more at lower prices, well, that sounds good in politics,
Yeah.
but it's kind of like academia. In academia, there's no difference between the real world and academia. And the only problem is in the real world, there is. Okay. And so what is said in politics and what happens are very perverse more commonly. And I'm not, I'm speaking to a Canadian audience. I don't have to explain that. You guys have seen some weird things up there the last few years. But I say that because do not take people for what they say, take them for what the economics of things are. And
Mhm.
so if you're going to shame and scare people in an industry away, you are increasing the return on capital that would be the minimum requirement as you introduce things like volatility in the industry, whether it be asset prices or the volatility of the underlying commodity. And if you give people more volatility, what do we know from academic theory? Well, we know that more volatility requires a higher return. So as you see this volatility, the people running businesses, they're not going to use their old IRR math. They're going to increase their IRR because with the volatility, they need to have a bigger, margin of safety, as Ben Graham used to say. And so the higher volatility, higher risk, lower price ideas are just adding to the IRR investors need, and thus operators will invest based on. And so you're seeing these rig counts and frac crews come down. Now, separate from that, this must be said, go look at the gas to oil ratio in the Permian even prior to this happening. And what you see is the gas to oil ratio is increasing. And so as that has been increasing, that naturally would require more investment to keep the oil amount coming out of the Permian higher. But secondly, as you watch rig counts and frac crews go off a cliff, which that gas has been less affected by that. It's been oil rigs that are more affected by that. Those things coinciding argue that two things. One, it's a cyclical, peak in the Permian oil production story, or more plausibly from our view, is it is a secular peak in the Permian story. Okay. Because ultimately, I think the other thing that we're going to have to deal with is if you're going to go out and say this is long-term capital, and then you invest it in assets that are 7-year assets, that is not long-term. And so there's going to be a matching of long term to long term. I think of it as like, if I run marathons, those are slow twitch muscles. If I run a sprint, those are fast twitch muscles. So I think about the Permian like a sprint. I think about tar sands like a marathon. And there's times where you want to sprint, you're going to get hit by a car. You better run. Okay. And you jogging ain't going to help you. Okay. There's times where short twitch muscles or short term assets can meet near term needs when, say, demand is quicker to pick up. But in the long run, that's going to be met predominantly by long-term assets or long twitch muscles. And so I think about that when I was talking about APA earlier, they have Permian assets, that's fast twitch. They have these call options on these offshore assets. Those are long-term assets. And so I think that's the kind of stuff that's going to come to fruition where people think about long-term, we're going to meet the degradation of these assets through long-term assets. But in the short term, there's times that we can fix this by meeting through new rigs in places that can draw a lot of oil in the next 2 to 3 years.
On the other hand, sometimes it's easy to be a doomer on the economy or certain businesses or US shale, but there's a entrepreneurial spirit in the States that exists, and it's easy
Yeah.
to discount that. How do you think about that when you just don't know what's coming up? There is that aspect where the industry continuously reinvents itself.
Yeah, there is. And to your point, where does it reinvent itself? It acts like a more mature business. So, for example, do I think these businesses can run with fewer headcount? 100%. That's what we're seeing. I mean,
Mhm.
like, I'll go back to APA. They've been cutting staff. Why? Because it's like, hey, tough times create tough people.
Exactly.
Okay, and that's your point. I think what we're going to see is the cost per dollar of revenue is in decline, but what's going on is it's just producing more free cash on even lower production numbers, which is
Mhm.
good for investors. So I completely agree. People are going to continue to tinker and right size the model and do stuff like that. So it's not like a dour for the businesses. It just means that in the next good era, so much more of the increase in the price of the barrel of oil is going to fall to the bottom line. Think back to like 08, 09. We got rid of a lot of American banks. There was a lot of consolidation. So what happened is things got better in the American economy and banking became more profitable. A lot more of that fell to the bottom line. And that's typical in a scale industry. That's, I think, that back to the point of, it's like the railroads. Buffett's talked a lot about the American railroads in that as they became fewer, they
Yeah.
became more profitable. And that I agree. They became more flexible, agile, things of that nature. But let me add one more thing though. This is not a negative picture of the future of the economy, whether we're talking about the world, the United States, or Canada.
Yeah.
And I think to your point, the human proclivity is to be too dour more often than not, particularly like I'll use the US right now. It's like people are like, oh man, the economy, it's on a knife's edge, it's gonna be miserable. Okay, like you hear Buffett like back in 2020 when he was bearish as all get out and practically, stuck beside himself. Charlie's not even on the shareholder meeting, it's all remote. And he's like, never bet against America. Well, he's really saying never bet against the tailwinds of the American economy. Now, look at what he's doing in his cash. He's not betting on the stock market. So I think there's got to be a divorce in people's mind between the economy is not the stock market and the economy is not investment opportunities. Okay. And I say that because the human arc is that things are going to go great and we're going to flourish and we're going to progress. Yes, in the Western world, we need to have a lot more children. That's a big problem. We got to figure that out. But again, to your point, we're creative, we're thoughtful, we eventually get the right reason and right answer, but it takes time. And you do not want to bet against humanity. There are people that do think we have too many humans. They're wrong. There are people who think that we're ruining our world. They're wrong.
Mhm.
And history will weigh that out.
Mhm. It's easy to do spreadsheet math and run a business on a spreadsheet, but sometimes there's intangibles like we mentioned that don't show up and are not, it's not a good idea to bet against those sort of things.
Well, I agree. And I'll add one more thing. Like, go to like, let's say you're going to do a remodel in your house. What does it cost to pay the demo crew
Mhm.
versus the person that builds something in that house?
Mhm.
It's easy to be a critic. It's easy to knock something down. It's very tough to build something. And I think that's why the human mind naturally gravitates towards a criticism of humanity rather than understanding that it's so profitable to build things and people will always be driven by creativity and profit.
Exactly. Exactly. I think the line you had was the future is bright for humanity, and along those lines, people have framed the energy industry as a sunset industry, yet demand continues to rise globally. How do you approach the long-term energy transition narrative as a contrarian value investor? Do you see a disconnect there and an opportunity as a result of that?
Yeah, it's a great question. And this is again, this is the inversion, if you will. So I think it was like the 98 Berkshire meeting. Buffett's talking about this idea of competition in the S&P 500. And at the time, the American stock market was running very high return on equity. And Munger and him were like, oh, it's not can't sustain at that level. And he said, let me give an example. What if you had 500 Jack Welches? And so he pulls out one of the greatest lines I've ever heard at the Berkshire meetings. He says, the secret to life is weak competition.
Yeah.
And I love that. By the way, as you guys can probably see, I'm 5'6". I'll call it, I was a strong high school athlete. That's about where I capped out in life. And I say that because you just want weak competition as a man or woman competing in anything. You just want your competitors to be worse. So, what are you saying? If I invert what you're saying, people are generally not optimistic about the space. They do not think it has a very long, story, right? The duration's very short in their mind. And I say out of that, wow, this is incredible.
Mhm.
If I can buy assets that are perceived to have a very short duration, but attractive returns on capital, like we talked about, and what if they're wrong? What if they're wrong about that assumption? Well, what ends up happening is I pay way too little for attractive returns that go on for much longer than people think. That is incredible. You should pray for those kind of circumstances to come to you as an investor. And most people want to sit around and say, no, I want to find a business that everyone's excited about. No, 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 because businesses that people are excited about, what they tend to do is they invite competition to
Yeah.
come in and they tend to invite new capital and IPOs and things of that nature. So, what do I like? Back to the scale thing. Um, it's tough for people to get public in the space. It's tough to raise capital. It's why we're going to consolidate. Effectively, you're going to take private assets and put them in the public markets because those companies already have access to capital. And you're going to put more publics inside more publics. And therefore, the access to capital is going to get better as they scale, not because people are overnight going to get more excited. And as we know with banks and bond markets, that more issuance through the same company tends to create tighter spreads. So, again, this is like following all in theory of what we've seen time and time again. But again, you don't want more competition in an industry. You want weak competition. So to your point about generalists, one of the things I don't like hearing is when people are like, oh, if we could just get a lot more generalists involved in the space, it would, make things better. Yeah, but if we do that, you're not going to get these prices. That's the problem. You don't want generalists to be involved. I don't want a bunch of bright entrepreneurial men and women coming up for the United States and saying, gee golly, Canada is just the greatest thing since sliced bread. We can make a pile of money. I want to take years. I want them to not figure out how fun the Calgary Stampede is to go out and learn about what's going on in Canada for years. I want them to figure it out when the loonies at par with the dollar and then they're all super bullish and you know that it's going to turn back to pumpkins and mice, but we're a long ways away from that. I want people to not understand this. I want them to be excited about AI capex and want nothing to do with this because ultimately that creates great investment opportunities for you as an investor because again it's back to that weak competition.
From the inside looking out, the Canadian energy market would seem pretty efficient, but from a American perspective, it seems like there's some inefficiency there that you spot.
Yeah, and let me we just look at it different than people do. So let me give an idea here. So I kind of like made fun of the idea of like, oh, price to free cash. It's a good metric for thinking about buybacks, but it might not tell you much about the returns of the business or the multiples on net worth, call it invested capital book multiple. Okay. So people say, well, here's our NAV. Okay. What does NAV mean? Well, it's the estimation of, again, the net asset value based on some metric.
Mhm.
Okay. Now, here's what I don't like about NAVs. In good times, people tell you their NAV's really high. In bad times, their NAV goes lower. That's
Mhm.
my problem with it.
Mhm.
Okay. Versus someone saying, hey, how much capital do we need to run our business? And what's the kind of free cash we can run over that?
Mhm.
And the industry doesn't tend to look at themselves like that. They look at their 1P NAV or things of that nature. We just don't look at it like that. I'm not saying that people shouldn't look at that, but again, we think we have a better metric for looking at it. And generally speaking, we've been more opportune to enter the space, be involved in the space, give our better thoughts as a shareholder in some of these businesses, things of that nature. And so I'd really get away from the idea of an asset value because asset values only really matter if you can generate attractive returns. And if you can't, your assets are worthless. And
Mhm.
so it's kind of the old value paradox that we've seen the last 15 years, which is like you're cheap. Yeah, but if you run low returns, you're cheap for a reason. Therefore, your NAV is a worthless metric to look at. It's like a book multiple where you drive really low returns. And so we just look at that very differently than the industry. And I think what you've seen is, again, if someone can cut out costs by buying a competitor, what are they really doing? They're driving higher returns, all things equal, compared to what the two entities were on a separate basis. And so I think that's where the trend of everything is going, is looking at invested capital multiples with returns on invested capital. Because ultimately, if you go across all securities, return on equity is not as good of a multiple as returns on or a way of looking at things as return on invested capital, because it's your total capital. It would mean that, yeah, it might be opportune to borrow money right now because your debt might be cheaper to you for the next 4 or 5 years than your equity is, but eventually you got to pay debt off. And so you have to think through the cycle on these things from a business management and a capital structure picture. And I think that's where we're going to end up on this industry, is just having a very simple way of looking at that, of what do you need to run the business? Is that debt or equity? And therefore, what's the long-term returns you run on your total capital structure?
And do you see the Canadian markets as maybe a little bit more inefficient than we might think they are from an insider perspective?
I just think marginally there's less liquidity. I mean, America's the largest casino in the world when it comes to the stock market.
Mhm.
By the way, John, where am I getting that idea? John Maynard Keynes wrote about that. I mean, he wrote about that a long time ago in the 20s, about how America had this big casino going on, and that tends to be. He would jokingly say it's like a farmer going out in the morning and checking, what their crop looked like in the morning, and then coming back at 4 o'clock later that afternoon and saying, "Hey, what does the crop look like today?"
Mhm.
Well, in the American stock market, they care a lot about what the crop looks like at 9 a.m. and what the crop looks like at 4 p.m. in the same day.
Mhm.
We tend to be a place that people become degenerates in euphorias. I'm not saying that there haven't been euphorias in Canada. It happens in all markets, but we tend to do it in the biggest way because we're the biggest market in the world. And so I just point that out because there's just more liquidity in America. In another part of the cycle, let's say oil and gas is king, and we wake up where everyone's involved in oil and gas, and what tends to happen is the Canadian issuers will trade at premiums compared to their American counterparts. Because again, when you get into a degenerate market in oil and gas, people say, no, if I want the real heroin, I want to own a Canadian oil and gas business because that's the real hardcore drugs. And so that's what causes them to pay a premium. Because when they go to their PM, they're like the sector analysts at the big shop. They're like, no, 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 we don't want this American stuff. The Canadians, they know real oil and gas. That's what happens at the other end of the cycle. Okay. And you can see that you can marginally buy these at bigger discounts because of the liquidity, not because of difference in assets, in my opinion. I think it's a liquidity issue. And so if you can arb liquidity, that's always a good thing. You can even do it intra-market. If I go out and look at Tamarack trades for a lower, invested capital multiple compared to some of the other names we own, but they run very similar returns on invested capital. So what are we doing in Tamarack? Tamarack, we are arbing the multiples because of the liquidity issue.
And if production falls off in the lower 48 was as a result of shale problems and whatnot, do you see American investors looking up north more to Canada for inventory and discounted oil names?
I mean, they will. They always will, and they already do, right? In other words, like if you're going to see people participating in the majors in Canada, that's their natural place to go. But again, I think as you watch on the consolidation side, think about it like this: as they watch consolidation go on, they're going to go from being like, great, I could buy the major, or I could buy what I think the major is going to want to buy,
Mhm.
and therefore I'm buying the major at a discount longer term. And I think that's going to be the next evolution of this. And so, like, I think, here we are in the middle of this like Meg Strathcona thing. And so people might be like, hey, I'll buy Meg because if I think someone else is going to offer on it, I'm effectively buying them more cheaply. That's if it was a stock deal, for example. Okay. And so I think that's the natural evolution of people thinking about this for wanting to kind of dip their toe elsewhere into the water rather than just going to the majors right away. I mean, if you're Fidelity, your capital group, I mean, you need liquidity.
Mhm.
And so you're not going to see large amounts of participation unless it's going on with a lot of liquidity. And that's kind of the liquidity trap, if you will, for some of the bigger pools of capital out there.
The investor term would be scuttlebutt or gossip or however you want to say it. But within your American network, does Canadian energy come up much?
I mean, we're in Phoenix, Arizona, like to be, the value crank out in the middle of the desert, like our investors are.
Yeah.
We don't really talk to many people because like who am I gonna, drive down the road and be like, hey, it's incredible what this whole Meg situation is. And my neighbors are going to look back at me like, bro,
Mm.
nobody cares. Okay. And I no, we like that. I mean, from a perspective of like doing independent research, you're truly doing independent research because no one that lives around you cares. And unless I'm running into someone where I get introduced or whatnot when I'm in some random city, how am I gonna meet or know or care? I mean, I spent a little bit of time, I ran into some sell side meetings out in New York when a lot of this stuff was coming out with Strathcona and Meg. And I remember like, oh, here's an ARB shop. And it's like, when do I run into an ARB shop outside of New York? I don't. Oh, here's a natural long in this space. I don't run into those kind of people. If you're thinking about the West Coast energy business from an investor perspective, it's us, Hotchkiss and Wiley down in LA, Dodge and Cox up in San Francisco. Yeah, Capital Group dabbles a little bit, but most of their real bold ideas are, somewhere in the AI CapEx game today. It's not in the energy business. And so I just point that out because ultimately you kind of know who the players are if someone's going to do their roadshow to the West Coast. And there's just not a lot of stops in that game today.
Do you go down to subsectors? Are you looking at that like the power markets right now?
Yeah, we haven't done anything in like the power market, so nothing in the utility space. Like I said earlier, we haven't owned any pure nat gas plays. Here's what I would say. We haven't owned this, but if someone says coal, the energy business can be better than people think, and people are going to end up with offshore assets, or long life assets like tar sands and offshore. Ultimately, one of the more interesting mental bets that's out there is I think a lot about like a business like Transocean, offshore business, right? If we ultimately end up with a lot of long dated assets dominating the market over time, an asset like that from a servicer perspective will do really well. I only say that it's heavily indebted. We haven't done anything on it, but just from a mental bet perspective, if we wake up in a world that's undersupplied, I could see a servicer like that doing really well. But again, we don't own anything like that today. We don't have to make that bet. But again, it shows you like where I'd want to go in the servicing market. Because again, your job as investors, if you're right, you want to make a lot of money, and that would be the way to possibly get paid odds on an idea like that, even though the average servicer might not do that well compared to the producers.
And how about the power markets?
Yeah, we do. We've done nothing else there. All the way up. Like usually get questions on uranium as well. It's like,
Mhm.
oh, are you guys involved in the uranium business? We just haven't. Part of this is preference and choice. Um, can we all say, that ultimately, uranium and nuclear is a great option to go create power? It is. I don't think anybody would debate that from our chair.
Mhm.
Um, it's a weird world we live in where there's just some parts of the world that they just have issue with nuclear, whether we're talking, big scale or small scale, etc. So I just look at it as like, we just know that's present in the human mind. They have something dark in the back of their mind that causes them a little more fear around that. It doesn't mean we're not going to do more nuclear. Energy consumption and supply has got to grow outright. We're going to do more of everything. The question is, do I think that's going to be a dominant way we made it in the future compared to the past? No, because all of time argues against that as it pertains to nuclear becoming bigger. What do I think we're going to do a lot of? We're going to do a lot more nat gas as it continues to power generation. But ultimately, as you think about incomes rising more really directly speak to oil, right? Jet fuel is a dominant use of oil today, just like transportation with automobiles is. And so as people get richer, what do? They drive bigger cars with fewer kids that they don't really need to drive those big cars, but ultimately they're wealthier. And with wealth, they tend to do things like fly more. And the wealthier they get, they tend to even waste even more money on jet fuel. It's called private jets. And that's the arc of history in that business. And so, do humans flourish? If they do, I think they're both positive, but we've chosen to go through the oil markets to go out and make that money today.
As we move towards the end of the conversation, what's the most misunderstood aspect of energy investing you've noticed lately from the perspective of a value-oriented generalist investor?
Yeah, it's a really good question. I think that ultimately that there's no control over the business, right? In other words, I said they're cyclical. Yeah, they're cyclical. But the idea that there's no control over the business. Use what I said earlier about cutting headcount. Okay, so I run a business. It's called Smead Capital Management. So when is it easy to do tough things? When times are tough. When your business is doing well, is it easy to come in and be like, hey, we're going to cut 10% of our headcount? Times have never been better. No, it looks bizarre to do that because you're like, wait, you've never made more money as a business, and you think you're being lethargic, and you think you're slow in what you do, and you're not really being that efficient. You build efficiencies in tough times. Nobody wants to make tough decisions like that in good times. So I tend to think about those things in the opposite fashion. You become the business you're going to be in the future from tough times, and you have, in many cases, a lot more control over your business at that juncture because you have the, call it, social and political capital to go and make tough decisions because everyone can understand why you do that. So, if you think about it, like, let's use Starbucks as an example, which is a business we used to own. You don't go tell people you're going to raise your coffee prices when your coffee, like the underlying commodity didn't go up. You do it when the underlying commodity does go up.
Mhm.
And then when the underlying commodity goes down, what do? You don't drop your prices. It's a scapegoat. It's cover in your business to go do the right things. And so I think a lot about that is out of these moments in the industry and in the businesses we're involved in, they make some of the best decisions they've ever made to right size and become more efficient. But you only find out about the reward of that at a later date in the business. No one sits back and says, "Gosh, we were so right to be a lot more efficient in what we do today." Based on that.
I really appreciate your time today.
Yeah, appreciate your time too.
If uh, if there's a chance, maybe we'll get part three in one of these days.
That'd be fun. I look forward to it.
And for the listener, the investors curious about Smead Capital and your thoughts and maybe your new fund, where can they find more information about the company?
Well, I'd love to have more information at some point, but smeadcap.com is the best place for them to go do that. And I'm sure we'll have more information as we come out and probably put out a press release as we get going. But we just look forward to doing business in Canada.